My name's Mark Cormack. I'm a director at Pinnacle Investment. Look, today it's great to be back with the Plato team to discuss Australian banks, the November reporting season, along with their dividend analysis. And today I'm delighted to be joined by Dr. Peter Gardner, a senior portfolio manager at Plato, whose primary responsibility is managing the Plato Australian Shares Income Fund. Pete, thanks for joining us.
Good to talk to you, Mark.
Okay, let's get straight into it. Hot off the press today, ANZ reported. What were the key insights?
Yeah, so overall it was a pretty poor result from ANZ, unfortunately. Its cash earnings were just over $3.1 billion, which was actually down 10.7% from what it was this time in the first half. And their FY24 earnings were overall down 6.6% on higher costs came through their business. They've just incorporated the Suncorp bank, which they've just taken over. So they had 2 months worth of that, which had made it a little bit messy. But overall, it was still a poor result. Their dividend was the same as in the first half. They increased the franking slightly because they had to pay a bit more tax. So overall, that's kind of good for our zero tax investors, and it equates to a 6.7% annual gross yield. They paid out 74% of their earnings, which is actually in line with all the major banks. Are almost identical in terms of their payout ratio now. And their net interest margin, which was the positive, actually rose 2 basis points. They also announced that they thought their synergies from incorporating the Suncorp Bank would come on a bit faster. And so overall, the market kind of hasn't punished them too much for this result, but I think that's partially because they've underperformed quite a bit into the lead up to this result. So the market, I think, was expecting a poor result from ANZ.
Okay, look, NAB reported yesterday. Looks profit was also down there. And looking at the headlines, NAB highlighted that arrears had jumped to its highest levels since COVID. So at no interest rate relief in sight. Is this as good as it gets for NAB, I suppose?
Yeah, so I mean, it was quite interesting in terms of both ANZ, NAB and Westpac just recently reported, and ANZ and Westpac didn't particularly report big increases in arrears, but NAB definitely did, as you pointed out, and you can see that in the little kind of chart on the right-hand side of your screen, where you can see the kind of 30-day arrears has gone up from 1.41% this time last year to 1.82%, which is a pretty kind of significant increase just over a year's period. But overall, the result from NAB was kind of a little bit disappointing, so not kind of as bad as the ANZ result. But given they'd outperformed a bit, the market did punish them a little bit for it. Their cash earnings were $3.5 billion, which was up 0.2% on the first half. But their total FY24 earnings were down 8.1%, which is consistent across the banks that generally had a pretty good year last year. And then they haven't done as well this year. The interim dividend was 85 cents, which is a 1 cent increase on the first half, which equates to a 6.1% annual gross yield. Obviously, the banks have performed pretty well, so that yield has then come down. Net interest margin fell 2 basis points, which was different than ANZ rising 2 basis points. And you can see their credit impairment charge of $365 million was a little bit above ANZ's. So NAB seem to be struggling a little bit more in this environment. I don't know if they're taking a little bit more risk in some of their loans, but they have reported increased kind of bad debts versus the other bad banks.
Now, Pete, you mentioned Westpac also reported earlier this week a lower profit, but they decided to undertake a buyback versus a special dividend. What were your key insights there?
Yeah, so it was a pretty decent result from Westpac. Their profit was up 9% on the first half. Overall, FY24 profit was down 3% on last year. They didn't perform as well last year as the other banks, but they have done a lot better this year. The interim dividend was also up 1 cent, similar to NAB. But you're right, they didn't declare a special dividend, which the market had been expecting, and we'd been expecting too, because Westpac do have excess capital on their balance sheet, and they've also got extra franking credits. And so we're a bit surprised that they opted to instead increase their buyback by $1 billion, which was different from the other banks as well, who didn't announce any increase in buyback, but Westpac did. So overall, their yield equates to 6.6%, or if you include the special they paid in May, that's 7.3%. And they have a similar payout ratio to the other bad debts. Their real highlight of their result was their credit impairment charge. If you recall, ANZ and NAB were 8 and 10 basis points. Theirs was just 4 basis points. And they were still able to grow their mortgages at 1.2 times the system. So a pretty decent result from Westpac.
Okay, last but not least, investment bank Macquarie reported last week what looked to be a pretty disappointing result. The stock was down, missing market expectations, although dividends were higher.
Yeah, so overall, it was a pretty weak result from Macquarie. I mean, you expect dividends to be higher given they are more of a growth company than the other major banks. But their profit was down 19% on the second half of last year. So it was up 15% versus the first half because they'd had a weak kind of first half last year. But it was kind of down on the second half. So it was a strong result from Macquarie Asset Management, which is benefiting from kind of high equity prices because that's a kind of annuity style funds management business. And also the banking division did well, but they had weaker results from Macquarie Capital and their commodity divisions, which are kind of impacted by subdued volatility. And also the Macquarie Capital are struggling a little bit from the higher interest rates that have come through, meaning their cost of capital is slightly higher. So their final dividend, as you pointed out, was up 2% to $2.60 on last year, which equates to a 3.3% annual gross yield. So a fair bit below the other banks. But as I said, it is a kind of growth company that's expected to kind of grow from here. And so because their Macquarie Capital and commodity divisions were weaker in the first half, they reduced their full year guidance for those divisions as well. Now, after saying that, post the kind of election of Donald Trump, Macquarie has been rallying more recently, so it's almost back to its highs again because people are kind of expecting the US banks and also the kind of Macquarie that operates in the US to benefit a little bit more in this environment of reduced regulation under a Trump administration.
Well, Pete, a great example of a stock that Plato's held for a long time that's delivered capital growth and a growing income stream. Now, I couldn't end our update without getting Plato's comments on the US election. What are your thoughts there?
Yeah, well, so far the election of Donald Trump has been positive for markets. I would say it looks like Trump will be a fair bit more inflationary in the US with reduced migration. And also he's planning to kind of kick out a lot of the undocumented workers. So that should lead to wage increases in the US, and also his policies on tariffs might also increase inflation over there. But for Australia, if China is actually sending less goods to the United States, it could actually be deflationary for us, funnily enough. So it's less clear the impact on Australia in that regard. The big worry would be if the policies Trump has causes a recession in China, which leads to less demand for Australian resources, particularly iron ore. But that's also not clear, as there is talk that China might stimulate the domestic economy more if Trump squeezes them. So there are some individual stock impacts where it's a bit more clear, such as increased tariffs being potentially bad for Breville, which sells goods into the US which are manufactured in China. Or alternatively, the US is probably likely to produce a bit more coal under Trump, which is good for explosives manufacturers that sell into the US market, such as Orica, which we hold in our fund. But for us, these kind of events just show the benefit of having a diversified portfolio with various different sectors, as some sectors are rising strongly and others are falling in this environment.
Agree, Pete. Look, a great example of why you need to be active when you're investing in equity income, especially as markets are so dynamic. And Plato certainly can show you that there's plenty of income in Australian equities. You need to be tactical, nimble, and know where to look. Just as a reminder, since inception, the Plato Australian Shares Income Fund has delivered over 9% income since inception. That's per annum income since inception. But really importantly, it's outperformed on a total return basis. Now, if you're after any further information on equity income investing, please do not hesitate to contact the Pinnacle distribution team or refer to the Plato website, www.plato.com.au. Thanks for watching and have a great day.
Thanks, everyone.